Welcome back, everyone. Ready for another deep dive? This week, we're taking on the stock market.
Buckle up. We're going way past those flashy headlines. We're using the Market Deep Dive report.
From January 13th to the 17th.
That's the one. It gives us that behind-the-scenes look at what really shook things up.
Exactly. It's like having a VIP pass to Wall Street.
Yeah.
We'll figure out not just what happened, but why, and most importantly, what it all means for you.
We'll crack the market's code, you could say, deciphering its whispers and shouts.
Okay, big picture first. The U.S. stock market, it had one heck of a week. Dow Jones up a whopping 3.7%, S&P 500 climbed 2.9%. Even the Nasdaq, the tech-heavy one, saw a 2.5% gain, a real rally.
The interesting thing here is this comes after a lot of uncertainty, right? So this upswing, I think it points to a growing sense of optimism about the U.S. economy. Those broad gains across the board really reflect that.
One of the big players in this positive swing was the December Consumer Price Index, the CPI.
Yeah.
And it came in lower than expected. Remember all that talk about inflation running wild? Well, this suggests things might be calming down a bit.
A lower CPI reading could mean the Fed, the Federal Reserve, might pump the brakes on those interest rate hikes a little.
Which would be great news for everyone, right? Businesses, consumers. Because cheaper borrowing means more money flowing in the economy.
Absolutely. It kind of fuels everything. This easing inflation is a big factor driving the market's good mood right now.
And speaking of good mood boosters, earnings season kicked off strong, especially for those big banks. They reported some impressive numbers, particularly in deal-making and trading. Citigroup, Goldman Sachs, JP Morgan Chase all beat expectations.
The financial sector's doing well. You can see it in these earnings, and that's a really good sign for the overall economic outlook. It shows stability.
Wall Street's feeling pretty confident then.
Right.
But there's always a but, isn't there?
Right.
And this time, it's Donald Trump's second term looming on the horizon.
Well, yeah, the market's trying to figure out what another Trump presidency means. There's the potential for tax cuts, deregulation. Businesses usually love that stuff.
But the thing is, nobody's quite sure what the real impact of these policies will be, how they'll play out in the long run.
Investors are a funny bunch. They love the idea of profits, obviously, but they hate unpredictability.
Yeah.
So there's this tension, potential gains versus potential risks. This cautious optimism is what we're seeing.
So let's zoom in on what happened in specific sectors. Financials, as we said, they took off. The XLF, that's the Financial Select Sector SPDR fund, it was up over 6%.
Makes sense, right. Lines up perfectly with those positive bank earnings and the whole optimistic economic outlook we were talking about.
Now, tech had a bit of a roller coaster week, but ended strong. Tesla, wow, they were the stars, gaining over 11% on positive projections for electric vehicles. And maybe some help from those potential government policies under Trump.
Tesla is a great example of how the same market conditions can affect different companies in totally different ways. Something we'll definitely explore more later on.
Healthcare had its ups and downs. Companies like Novo Nordisk and Eli Lilly, they took a bit of a hit from sector-specific news. Overall, though, the sector ended the week slightly up.
That volatility within healthcare shows why it's so important to look beyond the broad market trends. You got to understand what's going on in those individual sectors, those individual companies. It's the nuances that matter.
Totally. And then we had energy and materials having a good run. Rising commodity prices fueled that one, especially oil.
Yeah, that's a classic example of how something happening in the wider economy, like commodity prices going up, can have a direct impact on specific sectors. It's all connected.
Now let's talk about two stocks, Tesla and Moderna. They really show how different companies can be affected by the same market forces.
Okay.
So Tesla up over 11%.
Right. They're riding that electric vehicle wave and potentially benefiting from Trump's policies. Tax breaks for electric vehicles, infrastructure spending, all of that could be a big boost for them. It's all potential.
And then there's Moderna, down almost 17%. Ouch.
Well, Moderna's facing concerns about demand for their products in the future, especially as we move past that peak pandemic period. Investors are looking at things like increased competition, patents expiring, whether Moderna can come up with new products that people actually want. This is all part of it. It's a risk assessment.
It's fascinating, isn't it, how the market evaluates these two companies so differently, even though they're both operating in the same broad economic environment.
It really highlights the importance of understanding a company's unique situation, its industry, its growth potential. All of that matters when you're trying to figure out how it's performing in the market.
This market deep dive report isn't all about U.S. stocks, though. It also covers what's happening in the bond market, commodities, even Europe, Asia and those emerging markets.
Exactly, because the U.S. market doesn't exist in a vacuum. It's part of a global network. And what happens in one part of the world can definitely have ripple effects over here.
It really underscores how interconnected our financial world is, right? What happens on one side of the planet can affect things thousands of miles away.
Absolutely. That's why having a global perspective is so crucial when you're analyzing market trends,
Hmm.
making investment decisions. You can't just look at your own backyard. We were just talking about that global connection, right? How everything's linked.
Right.
And that kind of leads us perfectly into what went down in Europe and Asia last week. The report covers all that too.
Yeah, it does. And it wasn't all sunshine and roses over there, was it?
Europe. Well, they saw some gains, definitely reacting to that U.S. inflation data we talked about. But there's still some worry about their economic growth. The STOXX Europe 600 index, it did climb, but
Mm.
not as dramatically as what we saw in the U.S.
So more like cautious optimism over in Europe.
Exactly. Good way to put it. Now, Asia, that was a mixed bag. Japan's Nikkei actually went down.
Yeah.
Concerns about potential interest rate hikes by the Bank of Japan, that's what drove it.
And those rate hikes, they usually mean higher borrowing costs for everyone, right? Which can put a real damper on economic growth.
Exactly. Higher borrowing costs make it tougher for businesses to invest, expand. Consumers are less likely to spend too. So yeah, it can slow things down.
Sounds like Japan's got its own set of challenges then. What about China?
China's markets also dipped a bit. Persistent deflationary pressures over there. That's the culprit.
Deflation. Wait, isn't that when prices go down? That sounds like a good thing.
It might seem that way at first, yeah. But deflation can actually be pretty bad for an economy. It can make people hold back on spending because they think, hey, maybe prices will drop even more later. And businesses, they see their profits shrinking, so they're less likely to invest. It's a vicious cycle.
So each region is dealing with its own unique economic forces. Kind of like their own puzzle to solve.
Absolutely. And then you've got those emerging markets. They saw quite a bit of volatility, especially in India. Things were jumpy.
Oh, what happened in India?
Their stock market saw a lot of selling from those big institutional investors, the ones that invest across borders, pension funds, hedge funds, those guys. They can really move markets, especially in emerging economies.
So why were they selling off in India?
Hard to say for sure, but it could be a few things. Worries about India's economic growth, maybe, currency fluctuations, or maybe those investors are just shifting their strategy. Who knows? Whatever the reason, their selling definitely pushed those key Indian indices down. The Sensex, the Nifty.
It's a good reminder, isn't it? When things are looking rosy in the U.S., the global picture is always shifting. There's always something happening somewhere.
That's the reality. Investing always has some risk, and diversifying. Spreading your investments around different regions, different types of assets, that's how you manage that risk. It's like, don't put all your eggs in one basket, right?
Solid advice. Okay, let's look ahead now. What should we be keeping an eye on this coming week?
Earnings season keeps rolling. Big names are reporting. Netflix, Procter & Gamble, Johnson & Johnson.
Can they keep up that momentum we saw from the banks? That's the big question.
Right. Those earnings reports will tell us a lot about how different sectors are doing.
Yeah.
And they could definitely swing the market one way or the other. People react to those reports.
Are there any economic indicators we should be watching besides earnings?
Oh, absolutely. Here in the U.S., we've got data coming out on housing starts, manufacturing activity, retail sales, all that good stuff.
Those are the real bread and butter numbers, right?
Yeah.
Housing starts to tell us about the real estate market.
Yeah.
Manufacturing reflects how much we're producing. And retail sales show us how much people are spending.
Exactly. Those data releases will give us a much clearer picture of what's really going on, whether this economic optimism is built on solid ground or if there are some cracks under the surface.
And of course, we can't forget the political side of things. The markets will definitely be reacting to anything Trump's team does or says, especially when it comes to taxes, trade, regulations, those big policy areas.
A new administration always brings a dose of uncertainty, right? And the market doesn't like uncertainty. Investors will be glued to the news looking for any hints about how those policies might affect business, the economy. Everything's connected.
It feels like we're heading into a period where everyone's on high alert. Every little piece of news, every earnings report, economic data point, political statement, everyone's going to be analyzing it for its potential impact on the market. It's going to be intense.
You got it.
Well, I'd say we covered a lot of ground today. We went from that exciting stock market rally to the nitty-gritty of bond yields. We even touched on global trends. It's been quite the deep dive.
It has, and it just goes to show how everything's connected in the financial world, right? Company earnings, politics, the global economy, it's all part of this big dynamic system that never stops moving.
So what's the big takeaway for our listeners? What should they remember from all of this?
I think the big lesson here is, even though there's a lot of optimism out there, those risks and uncertainties, they're still hanging around. Stay informed, dig deeper than those headlines. That's how you really understand what's driving those market movements.
And remember, the market's not one big blob.
Yeah.
Different companies, different sectors, they react to the same events in their own way. Do your research, understand those specific risks and opportunities before you jump into any investment decisions.
Couldn't have said it better myself. Knowledge is power when it comes to investing, so keep learning, keep exploring. And as always, thanks for diving deep with us. Until next time.